When it comes to addressing China's rapidly growing EV market, two main companies come to mind for most investors: XPeng Motors and NIO. And well, despite both of these companies having performed exceptionally well over the past 2 years, there seems to be a divide in the investment community about whether or not either one of these companies is better than the other. And since obviously the Chinese economy is going through a very historic period right now, I think it's the right time to address and do a fundamental analysis on both these businesses to understand which one might give you the better returns in the next bull run. But as usual guys, before you get into it, make sure to drop me a thumbs up and hit that subscribe button if you haven't already. So to start things off, I want to give a little bit of a disclaimer. The information I'm going to share in this video is essentially meant to help you guys make better decisions, not only with comparing XPeng or NIO, but whatever stock you want to invest in. I'm not going to give you guys my opinion on which company is going to perform better because I have absolutely no idea on what's going to happen. All I'm going to share is the information that I'm using to make my investment decisions. And to be completely honest, with the way that the Chinese EV market is growing and the expectations of decarbonization related regulations over the next decade, both of these businesses will probably perform really well. It's just that investors most likely want to look for which one might outperform the other. And that question is exactly what I want to help you guys address in this video. But without further ado, let's get right into it and start by addressing the September delivery numbers for both of these companies, which came out just 2 days ago and happened to surprise a lot of investors. Starting things off with NIO, they came in with a 30% growth year over year in the third quarter deliveries, which included not only their SUVs, but also some of their newer sedans like the ET7. Now, the reason why this is such a big deal is because NIO is launching one of the only competitors to the Tesla Model S in the Chinese market with the ET7. And the ET5 is also expected to compete with the Model 3, which is obviously the best-selling Tesla in the world. And so it's no surprise that their deliveries are up significantly despite all the headwinds that China is facing, which overall is obviously a good thing for a business like NIO, which has obviously been struggling at least in the second quarter of this year. But now if we move on over to the other side of the coin and look at XPeng, as you can see, their deliveries for September were down 19% versus a year ago, whereas their Q3 deliveries totally were up 15% year over year. Now, this is a little bit misleading because in the screenshot I just showed you, they were comparing the Q3 deliveries of NIO at the very first part and then getting into the September deliveries. So basically the lowdown is that in the third quarter, XPeng grew by 15%, whereas NIO grew by 29%. Now, to be honest, the slower growth in XPeng's deliveries is not a big surprise because in the second quarter earnings call, they did guide for the Q3 deliveries to be much more below analyst estimates, anywhere between 29 to 31K. And as you can see, they came in right around that at around 29,570. Now, there could be a multitude of reasons why XPeng's growth is slowing, but the main one is probably that a lot of their demand was pulled forward in the early half of 2022, and they have not yet launched their G9 SUV, which is not recorded in the third quarter deliveries. If you look at the green bars, as you can see, in March and June of this year, XPeng recorded some fantastic deliveries, which actually broke the trend it had experienced in 2020 and 2021 when it comes to the seasonality of deliveries. If you look at the blue and orange bars, typically the start of the year is very slow, and then going into the third and fourth quarter, you really start seeing deliveries ramp up. But in 2022, the company banked the trend, and instead in the first half of the year, they saw amazing deliveries that outpaced NIO and even Li Auto. But obviously that means in the third and fourth quarter, they might see slower deliveries as a lot of their demand is pulled forward. And certainly that could be a big reason why NIO's deliveries in the first half of the year were slow, and now in the third and fourth quarter, we should expect them to ramp up deliveries and see record-breaking numbers. The Chinese consumer is obviously being very cautious in this kind of environment when China's recovering out of a recession, but the big headline reason why I am bullish on the Chinese EV sector regardless of what stock I invest in, it's because of the fact that they're cutting interest rates in 22 and 23. And the reason for that is pretty simple, because China is 6 to 12 months ahead of the US economy. Where the US economy right now is experiencing high inflation, China already experienced high inflation in 2020 and the early parts of 2021. Instead, now, because of their COVID lockdowns, they're actually experiencing deflation, and the Chinese government wants to reinduce more growth into the economy, which will propel money into the hands of consumers, and as a result, higher spending on higher class products. And that will most definitely play in the hands of better revenue and deliveries for all these Chinese EV makers who are already struggling in the short term because of the COVID lockdowns, which are completely out of their control. And say what you want about China, the rest of the world is way too dependent on their cheap manufacturing to completely let go of them, despite obviously all the political mayhem we've been seeing between China and the West. And to be honest, all the FUD we're seeing in headlines here in the US are just creating a better buying opportunity for investors who have the conviction to hold on to these companies despite the ups and the downs. But obviously that was a little bit more of a tangent, and instead now let's compare the revenue and gross margin of NIO and XPeng after we've already looked at their deliveries, because this is where things get really interesting if you're looking to understand which company is outperforming the other. As you can see, overall NIO's gross margin per car is higher than XPeng's, and since their deliveries in September were also higher, their gross profit came in much higher than XPeng's at around $116 million USD. And so it seemed like, based on this information, that NIO is the clear winner and that this is a stock you should be buying if you want to take advantage of the Chinese EV market. But obviously, as we all know, the stock market is not that simple. Instead, we need to give these numbers some context and actually dive into the fundamental balance sheets of both these businesses. As you can see, starting off with the income statement of NIO, they've seen some amazing growth over the past 2 years. Their obviously revenue has been on a great trajectory to the upside, but obviously that gross profit number I just showed you in that screenshot came from the fact that NIO's gross margin is pretty high compared to XPeng's. As you can see, it's sitting at around 13%, and it's actually gone down a little bit over the past few quarters, as obviously the supply chain issues are increasing the cost of raw goods, and this is something we've seen across all companies in the sector. And obviously operating and profit margins for not only NIO but also XPeng are negative because both of these companies right now are unprofitable. If we move on over to XPeng, as you can see, although they've been growing at a faster rate than NIO and they've seen revenues of around 7.44 billion over the past quarter, their gross margin is sitting at around 10.9% and has actually stayed relatively stable over the past few quarters instead of NIO's decline from around 30% gross margin to now 13%. But if you know anything about the automotive market, the single-handed reason why the gross margin for XPeng is low compared to NIO is because NIO right now sells lots of SUVs, not only in the compact segment but also in the luxury high-end segment. And SUVs always tend to have a better gross margin compared to sedans or even hatchbacks. And since right now XPeng's highest selling products, the P7 and the P5, are both sedans in the compact and sports sedan segment, it's clear to see why their gross margins are a little bit tighter than NIO's, who's already been in business for a little bit of a longer time than XPeng. But the key thing that's kept me a little bit more optimistic about XPeng's future in the short term is that their gross margin has stayed more stable over the past year, despite the macroeconomic headwinds we've been facing not only in China but in the global economy. Whereas as you can see, NIO's gross margin has been historically more volatile, where they saw 20% and now they're seeing 13%. And even if you cut out the operating expenses of the businesses, NIO's is sitting at around negative 27.6%, whereas XPeng is sitting at around negative 28.5%, which is not all that big of a difference considering the fact that XPeng is trading at a cheaper price to sales ratio than NIO. But obviously the income statement does not tell the whole story. Instead, we also need to look at the financial position of both companies as well as their valuation. And as you can see right now, NIO is trading at a valuation of around 4.34, which is a price to sales, because obviously the companies are not profitable and we cannot look at the PE ratio. But where things get really interesting is right here at the debt to equity and the current ratio. As you can see, NIO is sitting around 0.8 and 1.88 respectively. Whereas if we now move on over to XPeng, as you can see, their debt to equity ratio is around 0.13 and current ratio of around 1.97. Now, for those that don't know what the current ratio means, essentially this subtracts the current liabilities or debts of the company from their current assets or their cash position. And so the higher this number, generally the better, because it means that the company has a better liquidity position for the next 12 months. Whereas for the debt to equity ratio, you actually want this number to be as low as possible because you want debt to be very low and equity to be generally very high. And so the lower this number, the better of a financial position the company is in. And as you can see, compared to NIO's numbers, XPeng does look a little bit better from a financial standpoint. And that is obviously not even considering the fact that NIO is trading at a 4.34 price to sales, whereas XPeng is trading around half that at 2.3, meaning you're potentially getting a better deal with XPeng with better financial positioning. And it certainly seems like institutional investors here in the US are actually seeing this disparity and considering buying more shares in XPeng, as JP Morgan recently bought around 16.68 million shares on the Hong Kong exchange. And this news followed the fact that XPeng's own CEO also happened to buy 2.2 million shares on the US exchange of his own company, which is essentially a form of share buyback, as he expects the G9 SUV model to boost sales over the next couple of quarters. And as we all know, insiders can sell for a multitude of reasons, but they only buy for one reason, and that is potential share price appreciation. And the fact that XPeng stock is trading at around $12 when just a few months ago is trading at 35 really goes to show you might be getting a very good deal if you're optimistic on the Chinese economy and the EV sector. Because let's be honest, in the short term, these stocks are primarily driven by FUD, fear, and algorithms that are trading these stocks down on purpose, as we see so much fear and unnecessary skepticism around China's economy here in the West. And that leads to a lot of people trying to de-risk their investments and panic selling out of these companies, which obviously creates a good opportunity for opportunistic investors like us. Now, don't get me wrong, this does not mean I do not like NIO or any other Chinese EV maker as an investment. I'm simply showing you the technical and fundamental analysis that I have done to pick my investment on one company over the other, which can also help you hopefully analyze other businesses in the stock market. I think in the long term, both of these businesses and all the Chinese EV companies should prosper if they execute properly and if they maintain a good financial position. And obviously, it's very important to hear other folks' perspectives, so let me know your thoughts down in the comment section below.